Thanks. You should wait till it's done before you clap because it might be horrible.
Can you hear?
I was going to ask, can you hear? Because I had a cold this week, and so I'm not good. Are we good in the back? Are we awake in the back? No. Then it doesn't matter. Okay, so I'm going to tell you a story today about why there's slow growth in the world economy. And it's usually told as a story of income inequality leading to less aggregate demand because rich people have this funny habit of saving less than they earn. The economists call this the marginal propensity to consume, and rich people's marginal propensity to consume is lower than that of poor people. And that's a reasonably reasonable story, but it's not the whole story. And the reason it's not the whole story is that rich people have to get money from somewhere. So to really understand why there's slow growth in the world economy, you need to look at the other components of aggregate demand. You need to look at firms, because it's firms that generate economic activity. It's firms that generate the money that rich people get as income. And the basic story, so that you can take notes right now and then check out until the last 5 minutes, is that although it's really important to note that there's high levels of income inequality among individuals, it's just as important to note that there's high levels of what we can think of as income inequality, profitability inequality among firms. And I'll talk some numbers later. And the firms that get the biggest chunk of profits from global value chains get those biggest chunks because they control a variety of intellectual property rights. That's the intellectual property rights here in the title. Okay, so the basic story in one sentence is robust intellectual property rights lead to monopoly power in global markets. That leads to a concentration of profits. And as I'll explain later, the firms that end up with lots of money don't do very much investment. The firms that would like to invest don't end up with a lot of money. And the net result is stagnation. Okay, so we need to talk some numbers for a second because big numbers make people's heads explode. And I'm going to put some big numbers out. I want to give you a sense of what the numbers really mean. So here's the Obama stimulus in response to the 2008 financial crisis, the American Recovery and Reinvestment Act. It spent about $831 billion over a 3-year period, 2009 to 2011. So that's a lot of money. That's almost $1 trillion, right? That's why I say your heads explode. Nobody knows what $1 trillion is. I have about that much in pennies in my office drawer, but I don't have time to count them. Okay, so here's the Obama stimulus scaled against Apple. You know Apple, right? Apple's cash holdings, which these days, this is the 2014 number, but these days are about $215 billion. So one company has roughly a quarter, is sitting on cash equal to roughly a quarter of the Obama crisis stimulus. If we take the top 15 companies by just their offshore holdings, so not what they have parked in the US, but just their offshore holdings, those offshore holdings are actually larger than the Obama stimulus. And I give you the list on this side, and the reason I give you the list on this side is because although I'm going to call out one company here in purple, it's the oddball. For those of you who know Sesame Street, one of these things is not like the others. And the thing that makes Exxon not like the others is that Exxon is a company that deals in physical goods. It has a huge amount of physical infrastructure. It has a huge number of employees. These other companies, by and large, are dealing in stuff that's controlled through intellectual property rights. Okay? They deal in knowledge. They are what we sometimes think of as the information economy. And the alert ones among you will maybe say, but wait, Pepsi, that looks pretty physical. And the critical thing here is Pepsi actually doesn't do very much bottling of things. Most of the physical stuff is done by subcontractors. And so what I'll do later is link firms' strategies of acquiring intellectual property rights with the resulting industrial structure that produces, both domestically and globally. So here's 15 largest firms by offshore cash holdings. Most of them are firms who get their profits from intellectual property rights. If we take all non-financial US firms, total cash holdings, 2014, it's more than double the Obama stimulus. If we look globally, what's been happening in the US is happening everywhere else. And you don't need to look at the numbers on this. You can just look at the direction of the lines, which go up for Japan, Britain, and 2 other countries. And when we take all global firms, all global non-financial firms, 1,200 firms, and look at their cash holdings, they're sitting on a huge amount of untapped aggregate demand. Okay? So the simple thing here in terms of numbers is there's a lot of money out there that's sitting idle. Obama threw $800 billion at the worst post-war recession in US history. And at the same time he was doing that, firms were sitting globally on roughly 3 to 4 times that much money. Okay? Now, let's just think about what that means. And the way to think about that is a little bit of standard GDP accounting. For those of you who are not economists, this is pretty simple. For those of you who are economists, a little bit of review. Conventionally, GDP is understood as the sum of C, consumption. That's what people spend. G, government spending on infrastructure and other investments, but not government spending that's things like Social Security or transfer payments. That's in C, consumption. And I for investment, and then a little bit of a fudge factor for net imports, net exports, okay? So if that's true, then by definition, the rate of growth of GDP is determined by the rate of growth of these things. Delta C plus delta G plus delta I plus the delta on net exports gives you the delta on GDP, okay? Everybody good with that? Okay. So here's the usual explanation. It's that income inequality reduces consumption. But what about those other things? Those other things all flow from IPRs, okay, which affect government spending because all that money parked offshore, it's not getting taxed. All that money that's offshore is in principle sitting in tax havens. Government can't get its hands on it, so government spending is reduced. And it's not being invested, and here by investment, what we mean by the I in GDP accounting is new investment that creates productive resources. When I come in with my $1 trillion of pennies from my desk drawer and I buy the Irvine campus, that's not an investment in this sense. It's a transfer of money from me to the state of California, and they then have the problem of what to do with all those pennies. So nothing new was created. Okay, so what we're really concerned with when we look at I here is there something new being created? Okay, so we want to look at IPRs, intellectual property rights, in order to understand inequality among firms and how that affects not just delta C, not just the relatively slow growth of consumption, but also these other components of GDP growth, relatively slow growth of government and the relatively slow growth of investment. And when I say relatively, I mean relative to the years before 2008, from roughly the end of World War II to the big financial crisis. Okay? So here's what you're going to hear. This is actually a book, what you're hearing, but life is short. I can't give you the whole book. And the general argument, what this is telling you, the general argument is that there's a significant change in firms' strategies and firms' structures, firms' form of industrial organization. So for those of you who know the economic history literature, this is just Alfred Chandler, strategy and structure. There's a big change in firms' strategy and structure that happens from 1990 forward. In terms of firms' strategies, they increasingly concentrate on acquiring intellectual property rights. in order to get a monopoly position in the market. In terms of firms' structures, they shed all the labor-intensive things they can, either offshore to places with cheap labor, China, Vietnam, Indonesia, Bangladesh, Honduras, okay? And when they can't do that, what they do is they dump it domestically into labor subcontractors, okay? So it's not just manufacturing that's changed industrial structure, it's also big parts of the service sector. So the combination of firms' strategies and structure is what gives you stagnation. Not all firms are successful in doing this. What I'm going to end with is a discussion of a global wedding cake economy with firms at the bottom, very labor intense and low profit. Firms at the top, IPR intense and high profit, right? So competition sorts firms out too. And what I'll talk about today is these boxes in red: firm strategy, the global division of labor, and how we get to secular stagnation, slow growth at the end. And what I'm going to start with is the end. You know, movies always start at the end. They start at the end and they end at the end. So I take my cues from Hollywood, which is an important industry here. They know what they're doing, so I just copy them. So we're going to start at the end, which is secular stagnation, which is slow growth. And I'll give you some numbers to show you what I'm talking about. So here's growth rates by decade, weighted averages for the small rich countries. That's the blue bar. The big seven, that's the red bar. And then after the European Union adopts the euro, the green bar at the end. And what you can see is, and all you really need to get out of this is, it goes down. Growth rates go down. And they've been going down quite a bit since the 1990s. One reason is, and this is the usual reason, is people don't have enough money. Income inequality shrinks the amount of money available at the bottom of the income distribution, where bottom means the bottom 80, bottom 80%. And by concentrating income up at the top, where we have a very high rate of savings, it tends to shrink consumption. It reduces C, it reduces the growth of C, it reduces delta C. And what you see here is the wage share of GDP for all the big rich countries, some selected rich countries. The black line is the OECD average, that's the rich countries. And the peak here around 1997 is the peak of the 1960s to 1970s strike movement, which pushed the labor share of GDP up to its high point. And then we see a gradual decline as we go forward to the 2000s, 2010s. And in the US, the way this shapes up is this chart, which has been widely distributed, but still needs a little bit of explanation, I think. So 1948, 2014, what you're seeing here is an index of average wages in the US for production workers and productivity. So an index simply starts everything at 100 and then tells you the percentage change, and I've put this in percentage terms. And what you can see is that the US economy is pretty amazingly productive. Output in the US is 2.5 times, 250%, 250% larger, 2.5 times what it was in 1948, and actually a bit more than that, because this is actually just productivity, output per hour of labor. But in terms of compensation for that labor, right, from the 1970 peak on, it's basically flat. Wages are stagnant. And this creates a problem, right? From 48 to the mid-70s, wages, which you can think of as demand, grew in tandem with supply productivity. So the economy's in balance. And we have really fast rates of growth. Okay? But after the 70s, you get this gap. And the gap is significant because it means that money is accumulating in the top 20%, and within that, especially in the top 1% by income, and within that, in the top 0.1%, where saving rates are really high, and where that subtraction of demand maybe leads to slower growth. And it's not just a US phenomenon. It's pretty much a phenomenon everywhere. So these graphs are a little bit small, but you get the idea. There's 12 big countries here. They all show the same kind of gap, with the one exception being Germany. And that's because this is a graph of manufacturing wages. But when you look at the German economy overall, you see exactly the same thing as in the US, except this starts in 1990 because I can't actually get easily at the underlying data. So productivity in Germany goes up, wages are flat, people don't have money to spend, okay? And because they're not spending, we've got to ask the question, where's the money going? Why isn't there growth? And the reason we have to ask that question is, in normal accounting, if we saw something like this, okay? Red line, net productivity, supply. Blue line, wage stagnation at the bottom. And then, wow, the rich have a lot of money, right? Our first reaction might be, okay, that kind of explains why growth is slow. We can see why C might be not growing as fast as supply, why consumption doesn't grow as fast as supply. But we have to sort of scratch our heads and say, wait a minute, what do they do with all that money? What do the rich do with all that money? Well, they're investing it, right? So investment, should be picking up the slack and causing more growth. And sadly, that's not true. Because just as the wage share has fallen continuously, so has investment as a percentage of GDP. So this is a chart, just like the wage chart, that shows you investment trends from 1982 to 2014, again for groups of countries. And again, the critical thing here, don't worry too much about details, is that that line is going down. The dotted line is the G7 average. They're most of the rich country GDP, and you can see it trends down. Investment's falling also. So where's the money going? Where's the money going? And the answer to that question, and this is why we look at firms, is that the money is sitting in the hands of firms as cash and cash equivalents. It's passive investment. They're not creating new stuff. So here's American firms' cash holdings and cash equivalent holdings, things like T-bonds, for non-utility, non-financial firms, 1980 to 2010. And you can see the sharp jump at the end of the 1990s. And this is absolute dollars, okay? So we see they're holding a lot of cash. And again, if you're alert, you might be saying, well, okay, that line's going up. They're holding more cash, but the economy's getting bigger. So maybe there's actually just a constant level of cash holding here. And the answer to that question is actually no. Firms' assets are increasingly composed of cash and cash equivalents. So this is the percentage, right, of cash holdings by firms relative to their total assets. And again, this is for US firms, but it's not too much different for the other major economies. Okay? So what's going on here? What's going on here is what I said at the very beginning. Some firms have monopoly positions in the market because of their control over intellectual property rights, patents, trademark, brand. And if you remember Pepsi, Pepsi's a brand. And it's not just a brand, for those of you who have the can of Pepsi in your hands, it's not just Pepsi, it's a whole universe of brands that Pepsi controls. So patent, trademark, copyright, these give you monopolies. Again, because of where you are, the thing you're probably most familiar with is Disney, okay? And these intellectual property rights give firms a monopoly in the market. When you go out and you buy the Mickey Mouse hat, right? The production cost of the hat is trivial, partly because production's been offshored to places with low wage labor, but you still end up, I actually haven't been to Disney World in years, so the number may be wrong, I'm just guessing. You pay $15 or $20 for this hat, most of that's going to Disney for the logo and for the funny ears, okay? And only they can produce that. If you tried to produce Mickey Mouse hats in your basement, you know, because University of California keeps raising tuition and fees. You're looking for a way to make some money. So you start making these things and selling them on the street. Disney will be like taking you out, just like you see in Breaking Bad. Well, they do it with lawyers, not guns, okay? So these monopoly positions, they produce inequality of profits. And again, here's some numbers. I took the 2,000 largest firms in the world. This is the Forbes Global 2000 over a 10-year period. I calculated the Gini index for profits for those firms. Gini index as a measure of inequality. If you have a question about how you actually get it, save that for later, but the important thing to know is 0 is perfect equality. Everybody has exactly the same amount of money in a given population. 1 is perfect inequality. Whatever the size of the population is, one person or one firm has all the money. So the closer you are to 1, the more unequal you are. And the Gini index for profits for these firms, rounding up 0.65, is as unequal as some of the most unequal societies that we actually have accurate numbers for. So for example, South Africa, incredibly unequal society. Brazil, incredibly unequal society. And then to give you a sense of what an equal society looks like in terms of Gini index, right? Here's the 3 Scandinavian countries. So inequality of profits among firms is incredibly high. And that also shows up in offshore holdings. That's why those 15 biggest American firms can have cash sitting around that's larger than the Obama stimulus. There's actually an even higher Gini for offshore holdings. And if you want, I can explain why. Okay, so here's where we are. We know that income inequality alone can't explain why delta GDP is small. We have to also look at delta investment, delta government, and the pathway to understanding that is to look at the monopoly positions that firms have. And so that's what we're going to do now. We're going to look at firms' strategies and see what they've been doing. How did they get to this place? So this is where we are now, okay? Now, how many of you had econ, like whatever it is, 101 here, or intro econ, right? So they explain like public goods and all that, non-excludable, non-rival goods. How many of you are familiar with this? Okay, that's not bad. All right, so if you haven't seen this before, you can just ask your neighbor who put their hand up, and they'll be happy to explain it. They all understand this perfectly. But briefly, we can think about 4 different kinds of goods based on 2 characteristics. Can we easily exclude people from taking something? So air in this room is non-excludable unless I start strangling you, okay? And I will suck up all the oxygen from talking, but in principle, air is non-excludable, but this is excludable. I've got it in my grubby little hand and you're not getting it. The other axis here is rivalrousness of consumption or subtractability. And again, if the ventilation is working well, there's no subtractability. New air keeps coming in. But if I take a sip from this, it's gone. Consumption is rival, right? I just subtracted from the supply. And that gives us 4 kinds of goods. And for our purposes, the important thing to think about is that intellectual property rights are not, in this sense, a pure private good. Intellectual property rights are not like this bottle of water. Intellectual property rights are about things that initially are pure public goods. Initially, they're pure public goods. Why? Because they're ideas. They're ideas. And ideas are non-rival in consumption, okay? I'm going to put a bunch of ideas out in front of you. You will faithfully write them down on your notes. I don't know that there's an exam, but you'll tell your friends and neighbors about how amazing this talk was and send them to the video that this guy up there is making. And, right, you can all enjoy that, okay? It's not subtractable. Ideas are not subtractable. And ideas are, in principle, not excludable. Once UCI puts that video up on the web, anybody can watch it. So ideas are public goods. And what happens around intellectual property rights, the important word there is rights. The state says, you have a right to exclude people from using this thing. When Disney gets copyright around Mickey Mouse, Beauty and the Beast, all these things, they can exclude other people from using those ideas and then charge them. And that gives them a monopoly over that idea. When you patent a drug, when you copyright software, when you establish a brand like Coke, Pepsi, Nike, no one else can use those things, okay? And we know that this is hugely important because the arbiter of all that is valuable and important in American society tells us so. This shift, this government-created monopoly, is hugely important in creating profitability. And we know that because the arbiter of all that is good and important tells us so, and that's the stock market. The stock market values potential future streams of income. The value of a stock share is that potential future stream of income, discounted, risk-adjusted, whatever. But when you look at what composes the value in the market capitalization of the S&P 500, what you see is a huge shift from firms who are valued mostly in the basis of their tangible assets, factories, equipment, buildings, to firms that are valued on the basis of intangible assets, intellectual property rights, brand, goodwill. This is 87% of the value of the stock market now, okay? So the market tells us that this really matters. And because these things give you monopoly rights, and because a monopoly is multiplied by the stock market to a very large value, if you actually look at market capitalization, you can see in market capitalization the same inequality that I measured by a Gini index, right, which is this huge drop-off in market cap for a few big firms, and then there's the rest of them. There's the rest of the Global 2000. What are these firms up here? The first 20, 30, 40 firms? They're firms you know, right? It's Apple, it's Google, it's Cisco, okay? It's Coke and Pepsi. It's Pfizer, it's Johnson & Johnson, drug companies, okay? So firms understand this. When I did this talk for economists, I spent a lot of time explaining this. When I did this talk at Harvard Business School, they basically go like, yeah, well, what else is new? This is what we teach our students, okay? You want to get a monopoly in the market. Intellectual property rights give you a monopoly. And firms are very clear about this. Here's Google. You know that firm, okay? Here's Google. Google spent $12.5 billion. Even for me, that's a lot of money. They spent $12.5 billion buying Motorola Mobility. Motorola Mobility, they used to make cell phones. They made that first flip phone that people my generation love because it's like you got your Star Trek, communicator. And Motorola Mobility lives on. Here's a Motorola phone. It's made by a Chinese firm now. The Chinese firm bought the property right in this little M logo. But what Google bought Motorola Mobility for, and then it sold off the logo to the Chinese, what it bought it for was its patent portfolio. They didn't buy Motorola Mobility for its 0.5% market share, right? $12.5 billion for a 0.5% market share? No, that's insane. What was the value in that company? The value was all those profits. The company was defunct, but the patents live on. The copywritten software lives on, and it has value. It has value, and Sergey Brin tells you Larry Page tells you the value of that right here, with a little bit of cotton wool around it, but and I have to take my glasses off to read it. Acquiring Motorola increases competition, that's the cotton wool, by strengthening Google's patent portfolio, which protects Android from anti-competitive threats from Microsoft, Apple, other companies. What he means is it protects Google from being sued, and it allows Google to weaponize those patents to sue these other companies. So here's what firms do, right? You acquire these intellectual property rights. When a competitor comes along, you have a big stock market capitalization, you buy up the competitors. This Google's acquisitions. I have a chart for Microsoft. It can't be read because they buy so many things. And it's all about acquiring those intellectual property rights so you can sue somebody and thereby protect your market position. So here's the state of play in 2011, 2012 in terms of suits and countersuits in the cell phone ecology. You can pretty much see everybody at each other's throats. And we're talking big money here. Apple sued Samsung for billions of dollars over slide to unlock, right? And 3 other things. 3 of those things were trivial. Tap on a phone number and the phone dials. Slide to unlock, trivial. A search function. So for several $billion, it's still in litigation. The fine is now down to merely hundreds of millions of dollars. But the lawsuit's been going on for 4 years. And that means that Samsung is blocked from doing these things. And for those of you who have Samsung phones, what you know is Samsung had to spend some money to do something different from slide to unlock. So they make 9 dots. Okay. Great. But it costs them money to do that. And there's other less trivial things. And we actually have some numbers on what the cost of this is. Here's the cost of innovating around a patent. Patents are a barrier to entry. This is from the Congressional Research Service. They're pretty neutral. They don't have a dog in this fight. Okay. The patents give you a monopoly position. A competitor comes along, some bright young people come along with a better product, a better algorithm for ads, a better mapping software. You know, Google does maps too, right? Because they want to make autonomous cars. Waze comes along with a better mapping software and one that actually automatically updates, because whenever you use Waze, you're updating the map for them. And so Google correctly perceives this to be a threat to their monopoly position. They buy up Waze. Okay, you guys all know Waze because, as I understand it, everybody in California uses Waze. In fact, I see students using it to navigate between buildings here, right? That's trivial in the sense that it doesn't affect our lives that much. But for things that really matter, you see the same processes. This is news from these last 6 months, right? You guys know EpiPen? Okay, so EpiPen it delivers adrenaline to a person who's going into anaphylactic shock because of allergies. So this is a life and death issue. And Mylan, which is the company that makes the EpiPen, raised prices from roughly $50 a unit to $650 a unit over the last 5 years. And they can do that because they control the patent around the injector. They don't control what's in the injector. It's adrenaline. It's out of patent. Anybody can make it. They control the injector. And remember I said pure public goods are turned into franchise goods? Well, the EpiPen device is not invented by Mylan. Mylan just buys it up. The EpiPen device was developed by the Department of Defense, so soldiers would have a way to give themselves an anti-serum in case of nerve gas attacks in a way that was idiot-proof, which is exactly what you want for this kind of thing, right? If it's allergies as well. You just stab the thing into your leg. So the US Defense Department developed this, and then the company that originally produced these things for the Defense Department gets bought up by Mylan. They package this as the EpiPen. They control the patent now, and they make a lot of money. And that's generalizable. Here's the rates of increase of prices for branded drugs, patented drugs in the US over the last decade. Inflation rate in the US economy is 2% a year. Inflation rate for drugs, considerably higher. To put this in context, over this entire period, the increase in prices for all drugs sold in Europe that were branded, about 8.5%. The increase in prices for drugs in Britain that were patented, about 9%. That's because they actually bargain. So in other words, 1 year's inflation was 10 years' inflation in those other countries. So firm strategies: get an intellectual property right, have a monopoly, acquire profits. Now here's the structure part of this. Okay, so we're here now. Global division of labor, domestic division of labor. If you're sitting in the CEO's chair, as I hope you all are, and when you're there, I hope you remember your alma mater, UCI, so that the faculty, the esteemed faculty here, can retire quietly in comfort after their hard labor, making you smart people able to become CEOs. If you're sitting in the CEO's chair, you're under pressure from the stock market to increase your return on equity and your return on assets. And if you're sitting there looking at the world, you say, where do our profits come from? Well, it comes from these intellectual property rights, and they're just pieces of paper. If we got rid of all those workers who just put things together, then we could concentrate all the income from the intellectual property rights on a much smaller number of employees, including ourselves. And if we got rid of all the physical capital, which anyway is expensive and we don't really want to hold it, that also reduces our asset footprint, and so our return on assets will go up. And so it's win-win. We get rid of the workers, we get rid of the machines, we just have a pure stream of money coming in the ideal case, attached to simply a piece of paper, and then we have incredible return on assets, return on equity. We can make a lot of money. So the strategy is to get rid of everybody but core employees. Keep your software engineers, get rid of everyone else. Apple used to make computers, and by make computers, I mean they would build them in Singapore, okay, with cheap labor, but they were actually building computers. They had factories that were full of people building computers with parts that they manufactured, some of those parts that they manufactured. And now that's not true. Apple is just a company producing software. Everything else that goes into the physical product, so for those of you who have the Apple phone, I'll pretend this is an Apple, but I'm not cool enough to have one. Apple phone, everything physical in that phone is made by somebody else, including the chip, which is made by Samsung. All Apple contributes is software and design, okay? So they're physical asset light and they're labor light. And they've pushed the labor out into other firms. They've pushed the physical assets out into other firms. And that gives you a division of labor globally. It gives you the same division of labor domestically. I'll explain the difference in a second, but it's pretty simple. You have a company that's human capital intense, software engineers, brand engineers, okay? People who write scripts. These things can have an intellectual property right attached to them, okay? They have someone else produce the goods with a subcontract. So Apple subcontracts to Foxconn, which is a Taiwanese firm. Apple has about 30,000 real employees, people who code, 90,000 employees if you count people in the Genius stores. Foxconn has 1 million people building things, okay? Apple subcontracts to Foxconn. Where does Foxconn get the parts from? Apple arranges for shipments of parts from all over the world. Many of those parts are made by companies that have a huge physical capital investment. Making semiconductor chips requires a huge investment in physical capital. So you end up with a global division of labor where you have a company that's human capital intense, subcontracting production to a firm that's labor intensive production, using parts made by physical capital intensive firms. And it's not just tech. It's also something as simple, seemingly simple as hotels. So if you think about Hilton Hotels, it's a brand family. You walk into a Hilton hotel, you walk under the brand, but when you walk into the hotel, that building is owned by a different company, typically a real estate investment trust, or if this wasn't the University of California, I'd be pointing to the faculty and saying, their pension plan, it's my pension plan, owns these buildings. And you walk up to the counter and you say hello to the check-in clerk, and she smiles at you, and she's actually a subcontracted worker brought in by a third firm that simply supplies labor. So you see that same wedding cake structure. And that's a deliberate outcome of strategies around obtaining intellectual property rights and using them to construct monopolies. The connection to investment and government now should be kind of clear. First, the companies that have intellectual property rights get a lot of cash in their hands. As I said before, they park it offshore in tax havens, so they pay no taxes. It puts government under fiscal pressure. It creates political pressure for cutting spending to get budgets into balance. Basically, it weakens the taxation capacity of these governments. If we take that $3.5 trillion of cash that's being held globally, and we just say for the sake of argument, and we round up to 3.6 because it's easier math, 3.6 trillion, just say for the sake of argument that 25% is due as taxes, that's $800 billion. That's the Obama stimulus, right? Governments have the global equivalent of an Obama stimulus sitting in unpaid taxes because of all this cash that's parked offshore. That's why delta G is low. And if we think about the investment side, Apple gets money as profits, okay? But when they quote unquote invest, what do? They're not building factories. When they invest, maybe at the margin they hire some more software engineers. Those engineers are really well paid, so some of the cash goes to them. And actually, there's an incredibly strong correlation between the profitability of firms and the kind of wages that people get, regardless of what they're doing. Secretaries at Apple are better paid than secretaries at UCI. Okay? They get the money, they pay good salary to these people, but these people don't invest. What they do is they chase positional goods. They bid up the cost of housing in Silicon Valley. Meanwhile, companies like Toshiba, Intel, et cetera, right? They're trying to do physical capital investment. They're not getting the same rate of profit. It's good, but it's not the same as Apple's. And then, of course, down at the bottom, here's the really badly paid people in the Foxcons or in hospitality services. Okay? So they're never going to do any investment. Foxconn doesn't invest. Hospitality services doesn't invest. So investment's constrained. And these are the numbers behind that. We don't really have time to kind of go over them, but hint, I'm pretty sure these slides will be up online with the video if you want to go back and look at them. The important thing is to look at the number on the bottom, profit as a percentage of sales. 21%, 30% for Qualcomm and Apple, who supply IPR-related material for the iPhone. 8 and 10% for the people supplying the physical goods. 2.6% for Foxconn. Okay, so you get the idea. And so now we can go back to this, and we can put the pieces together. We have slow global growth. How come? Growth, delta GDP, is delta consumption, delta investment, delta government. Globally, exports net out, so you can forget about that. We know why delta consumption is lower. The bottom 80% of the population in the US, stagnant incomes for 30 years. Okay? The money that they are not getting is going into the hands of the 1% and the 0.1%. They use that to bid up positional goods. They buy shares in companies that have intellectual property rights. Those companies have monopoly positions in the market. They're accruing the money that is what is paid out to the high-income individuals as dividends, capital gains, share buybacks. But these companies don't have any need to invest in a big sense, right? Again, they hire people, they don't build things, okay? So investment is lower than it otherwise would be. And because they quite rationally take advantage of their ability to avoid taxes by parking money offshore, delta government is also low. So this is a better explanation than just pointing to income inequality. It tells you where the income inequality is coming from. It tells you about the other bits of GDP. So now I'm happy to take some questions.